Hi, in this video, we'll take a look at an example that combines everything that we have learned so far, and we'll try to work out the stock price in this example. So suppose we have a firm with initial book value on a per share basis of £100. So in the first 2 years, the ROE is going to be 50%, and the firm has decided to pay out 30% of its earnings as dividend, and so it's implied 70% is going to be reinvested to the firm. So the plowback ratio here is 70%. And starting from the third year and onwards, the ROE is going to decrease to 20%. And the firm is going to pay out 50% of the earnings and reinvest the rest of the 50%. Okay, and the expected return for this firm stays constant at 15%. So this will be used for the discounting. Now the problem is, how do we decide the stock price at the present times? Okay, so we have been given a bunch of information, and it is not as straightforward as the simple dividend discount model or the Gordon growth model would solve. Okay, so let's do it step by step. Okay, so since we have two stages here, it is not going to be solved by just one step or a simple two-step by plugging in the numbers into the formulas. So we have to lay out some basic information and work out some of those intermediate steps. Okay, so again, we would love to start with the time horizon here. Okay, so you always start with year 0 here, and we have year 1, 2, 3, and 4, and we stop at 4 because we already know that starting from the third year and onwards, it's going to stay the same. Okay, so we only need 4 years. Right, now starting at year 0, we have 100 for the book value. Okay, so do not confuse book value with the price or the market price or the market value here. Whenever we're putting a price on the stock, it's always going to be the market price. Okay, so the book value here is not the price, right? So in the first year, we would have the ROE of 50%, same with the second year, and for the third and fourth year and onwards, it's going to be 20%. Okay, so what we need here is going to be the EPS or the earnings. So from the return on equity, we would calculate the EPS per share. Okay, so let's first do the EPS here. So for the first year, the EPS is going to be 100 times 50%, which is 50 here. Okay, let's just write 50 here. And out of that £50, 30% is paid out as dividend. So the rest of the 70% is reinvested. Okay, so 35 here is plowback, and the dividend here, also in pounds, would be 15. Okay, and this plowback will go back to the book value. Okay, so since it's reinvested, it's going to increase our book value for the next period, right? So we'll stay here with the expected return, 15%, 15%, 15%, 15%, all across the years, and the growth, we'll do it later here. Okay, so here we have 100 as the initial book value, added with the plowback was in reinvestment, it goes up to 135. So from this here, the book value here, we can know the growth rate from year 0 to year 1 is 35%. Okay, and alternatively, you can use what we have learned before, is that the growth rate is the product of the ROE and the plowback ratio. So in this case, the plowback ratio is 70%. So 50% times 70% is going to be 35%. So this is consistent with what we have learned. Okay, so this growth rate here is 35%. And as we can see, the growth rate here is larger than the expected return. So we cannot use the Gordon growth model or the dividend discount model. Okay, but luckily it does not hold forever. Okay, this growth does not hold forever. So let's continue with year 2. So we have ROE at 50% again. So the earning for year 2 is going to be 135 multiplied by 50%. which is 67.5. Okay, and then the payout is 30%, so the dividend is 20.25, and the plowback is going to be 47.25. Okay, and again, the growth is also 35% here. Okay, right, now we enter year 3. So starting from year 3, the ROE decreases, but then we first need the book value here. The book value would be this 135 plus 47.25 here. So that's going to be 122.25, right? So starting from this year, we'll use a lower ROE. So the new ROE will be 20%, and the EPS here, the earning here, would be 36.45. Okay, so basically this number multiplied by 20%. Okay, so half of it is paid out here. Okay, so we'll just keep 2 decimal points. So that's going to be 18.23 as well. Okay, so there will be minor errors, rounding errors. So it's going to be fine, right? It's going to be fine. Okay, so the growth here is no longer 35%. So the growth starting from this year is going to be the ROE times the new plowback ratio, which is 50%, and the new ROE as well. So it's going to be 10% starting from this year, right? Then we only need 1 more year before we can calculate the price here. Okay, so let's again add the reinvestment back to the book value. So it gives us 200.48. Okay, and then we continue this practice by multiplying the book value by the ROE here, which gives us 40.1 for the EPS, and the plowback would be 20.05, as well as the dividend 20.05. Okay, so now we have enough information to work out P0. Okay, so since we know it's going to grow in perpetuity after the 3rd year, so we can use the Gordon growth model, but only for P3, not P0. Okay, so we can calculate P3 by using D4 minus divided by R minus G. So this is the reason we need 4 years. Okay, so remember, when we use the Gordon growth model or the dividend discount model, we always discount the future dividend, not the current dividend. So to know P3, we would need D4 here, right? So this is the reason we need 4 years. Okay, so but P3 is not the final answer. We still need something more. So if you remember from the dividend discount model, from the derivation there, we sort of started with P0 is actually D1 plus P1 over 1 plus R, right? And then we substituted out the P1 with P2 and then P3. So do we know P3 here? Yes, we do. We have P3. So we can substitute the P1 just twice until we have P3 here. So what we're left with is P0 is going to be D1 divided by 1 plus R, and then D2, 1 plus R to the power of 2, and then D3, that's going to be 1 plus R to the power of 3, and then plus P3 divided by 1 plus R to the power of 3. And do we have P3 here? Yes, we do. We have P3 expressed by D4 over R minus G. Okay, so finally, we would have everything that we need to calculate the price. Okay, D2 here, 1 plus R to the power of 2, plus D3, okay, 1 plus R to the power of 3, plus D4, R minus G, and then divided by, or discounted back to the present, using this, okay? Right? So this is how we calculate the P0. The rest of this problem is basically plugging in the numbers here. Do we have D1? Yes, we do. D1 is here, D2 is here, D3 is here, D4 here, and we have the growth as well. Okay, so the growth here is 10%, and the required return, or R here, is 15%, which has been kept constant, right? So we just need to plug in the numbers and we should have a price that is around 303.97. Okay, so you might get a very different number, but not very different number, but very close number, which is like 304, depending on how you round the numbers here. Okay, so this is a numerical example that combines everything we have learned so far. So the key idea here is that you need to use these formulas, or Gordon growth model, or the dividend discount model, in a very flexible way. Okay, so whenever you have multiple periods or multiple growth rate, it is advised to write out these years. Okay, so to expand the years and expand each item this way, so you can calculate the dividends for each year until you get something constant, like a constant growth and a constant dividend. In this case, that happens after year 3. Okay, so before you get something that's stabilized in this way, you need to do it manually. Okay, so hopefully you have learned to do the calculations and to put a price on the stocks like this. Okay, and I'll see you in the next video.